The fifth largest bank right now in the United States is a bank called US Bancorp, and it's not looking good. Okay, this is just my commentary. First of all, Warren Buffett owned 42 million shares of US Bancorp. They sold all of it. Okay, they saw things there that they didn't like. Most importantly, Charlie Munger said, we see real estate problems with commercial real estate. And did you know that 50% of all commercial real estate loans in the USA are from regional banks?
Greg Foss, the executive director of strategic initiatives at Validus Power Corporation and renowned Bitcoin enthusiast, believes the banking sector crisis in the United States is only in its first stage, and we are about to see even more collapses. According to Foss, US Bancorp, the fifth largest bank by assets in the United States, could be the next bank to fall, indicating the beginning of another wave that could spur more banking sector collapses. And Foss is not the only one concerned about the balance sheet of the super-regional bank. Last month, Holdco Asset Management, a respected investor in the banking industry, issued a scathing short sale report on US Bancorp, describing the Minneapolis-based bank as the unsafest and unsoundest of them all. In the report, Holdco noted that US Bancorp is poorly capitalized and is likely to have to raise capital and potentially even cut its strong dividend in the near future. Like other banks, US Bancorp has a lot of unrealized losses in its balance sheets from investing heavily in US Treasury bills and mortgage-backed securities when interest rates were low. The bank might be able to recoup its losses if it is able to hold the underwater securities to maturity, but that depends on what the Federal Reserve and the gloomy economy have in store for the banking sector in the coming months. According to Foss, the collapses we've had so far are from interest rate risks, and there is still a credit risk in store for banks in the United States. In its report, Holdco also addressed the issue of US Bancorp's Common Equity Tier 1 CET1 capital ratio. In the first quarter of 2023, the bank's CET1 ratio was 8.5%, much lower than its peers, and its early 2022 9.8% CET1 ratio. If the unrealized losses from bonds held for sale were applied, the bank's CET1 ratio would fall to 5.8%, which is well below the 7% CET1 requirement. In a recent interview, Foss details his outlook on the U.S. banking sector crisis, the immediate causes of the crisis, the role of the Federal Reserve, and what to expect in the next phase of the crisis. Please watch the video to the end, smash the like button, and subscribe to the channel to stay sufficiently updated on important market trends. Thanks, and enjoy the video.
Always there is somebody to blame. I'll explain why they're going under first, and then we'll probably be able to, piece together the reasons pretty easily. So first of all, what people need to understand about banking, and this is ubiquitous across the world. It doesn't matter if you're a bank in Bulgaria versus a bank in Europe versus a bank in United States, okay? All banks have a tremendous amount of leverage, which is to say that for every $100 of loans they make, which on a bank's balance sheet, loans are assets, for every $100 of assets, they only hold $4 of their own equity capital. The other $96 is borrowed from other people, meaning it's borrowed from other depositors, right? Depositors essentially make loans to the bank. The bank takes these loans and then relends it out in effort to make what's called a net interest margin, right? They pay depositors a certain amount of money, a pretty minute spread over zero. Then they lend it out, and that spread is called your net interest margin. But they do it levered 25 times or more. How do I get 25 times? Again, $4 of equity capital on $100 of assets. There's your 25 times leverage. So those assets can change in dollar value, market value, due to a number of things. Primarily with banks, it's because of credit risk. It's because you lend money to a counterparty and their credit quality goes down, or their perceived credit quality goes down because the world enters a recession or whatever. That's credit risk. And that's reflected in things like a widening spread that you're supposed to lend to Plamen. Plamen goes to the bank. 2 years ago, Plamen can borrow at prime plus 2%. Now, because of changed conditions, including potentially the change condition of Plamen, the proper rate is prime plus 4%. Well, that incremental 2%, which is not being charged on the loan, gets reflected in the price of the loan, which changes from $100, it goes down to, let's say, $90. So that essentially the yield makes up for the risk, the changed risk of Plamen. That's pretty simple, right? But the problem is when the mark to market goes from $100 down to $90, and you're only holding $4 of equity capital, that means the other $6 is depositors' money. Essentially, they've lost that money on a mark-to-market basis. That's credit risk. What's got the banks in trouble primarily in the United States and, globally is not because so much that the credit quality changed yet, it's because the interest rate environment changed. They were taking these short-term deposits and lending them out to long-term government borrowers at low interest rates. Now, here's the thing. They were able to capture an increased net interest margin because of the upward shape of the yield curve and because all the central banks were saying things like interest rates are going to remain lower for longer, right? Well, the bankers said, well, if they're going to remain lower for longer, I can take these deposits, move them out on the yield curve, and capture a larger net interest margin because of the shape of the yield curve, the upward sloping yield curve. Well, guess what? They were wrong because interest rates didn't remain lower for longer. In fact, interest rates have increased at the fastest pace in history. Yeah. Okay, which means when interest rates go up, bond prices go down, which means the mark-to-market loss on the bank's balance sheet is substantial due to interest rate risk, not necessarily credit risk. Now, here's the problem. We haven't even hit the credit crisis yet, and banks have had to chew through a lot of their risk-absorbing equity capital because of interest rate risk. So the banks are undercapitalized.
On the question of who's to blame for the crisis, Foss believes the blame should be shared equally between the risk managers of banks for mismatching short-term deposits with long-term bonds and, of course, central bankers for assuring banks that interest rates would remain low. But interest rates did not remain low. Instead, they jerked it up even faster than Paul Volcker's historic rate hikes in the 80s. According to Foss, the unprecedented pace of the rate hikes and the ready-to-fail structure of the U.S. banking sector are both recipes for disaster, and we are bound to have more banking sector collapses soon. Not even the too-big-to-fail banks are completely immune from what's coming, according to one of Foss' latest tweets, which reads, Bank of America has a market cap of $200 billion. JP Morgan has a market cap of $400 billion. Both are levered 20 to 25 times to their risk-absorbing equity base, which makes the stocks very risky and potentially overvalued. In another tweet, Foss criticized American TV personality Jim Cramer's take on the whole banking sector crisis. The tweet reads, XYZ is a really well-managed bank, says Jimbo Cramer and all the other fiat fools out there. You wouldn't know a well-managed bank if it hit you in the face. At 25x leverage to their book equity, all banks are risky. Let's get back to the interview as Foss gives more detail on the ongoing banking sector crisis.
You have to look at the bank management, the risk managers of the bank, and say, guys, you shouldn't have been mismatching short-term deposits with long-term treasury bonds. That's called GAAP, interest rate risk management. But here's the problem. They were told interest rates are going to stay lower for longer. So there's a little bit of blame from the bank risk asset managers. There's definitely blame from the central bankers.
The way they communicated things and what they said that they're going to do.
Correct. And then here's the one that I think makes the most impact is not just the fact that they raised rates, but they went so fast. Again, the fastest in history. I sent out a tweet this morning that shows the growth of interest rates compared to other epochs in history, recent history. The point is, Plamen, the banks are in bad shape, but banks are always risky. Everyone assumes banks aren't risky, but how can you not be risky if you lever yourself 25 times? That's risky. That's the nature of banking. So maybe Americans or the world is waking up to how risky banking actually is. Famous American Henry Ford actually said, though, over 100 years ago, he said if the average American understood how banking works, there'd be a revolution in the morning. So this was 100 years ago. So you see, like, banking hasn't changed that much. It's just people don't understand. They take it for granted. Oh, these things are too big to fail. Some of them are too big to fail, but none of them, zero of them, are too big not to see their stock price go down. And this is my biggest thing, is that bank stock prices are mispriced, and they're still mispriced relative to the true risk that you are absorbing. So, I don't think depositors in the short term are going to lose money. I don't think the US can afford to let depositors participate in like a Cyprus type bail-in. But that doesn't mean that bank stocks can't continue to go way down. And you're seeing that. Even Warren Buffett has been selling his bank stocks. And, he's the guy that says Jerome Powell's doing a good job. And by the same token, he's selling bank stocks because he thinks the banking system is blowing up. So one of those things doesn't add up, okay? Either Powell's doing a good job and bank stocks will be sound, or Powell's not doing a good job and bank stocks will continue to get weak. So Warren Buffett's talking out of both sides of his mouth. Or no, in the last 30 years rather, 10,000 banks have either closed or merged, so that you go from 15,000 down to 5,000. There's still another 4,000 that they need to close or merge. That's what's going to happen. So the big banks will get bigger. The small banks will either go out of business or merge with another bank. And that makes the system more centralized. But in my opinion, this is one area where centralization is actually good, because banking is a very bad or tough business. And if you don't have a good banker, you fail quickly. And I think we're seeing that there's a lot of not good bankers in the United States. So I don't think we're through this by any means. Don't overthink things. Banking is risky. Interest rate risk has caused most of the problems. Credit risk is coming. And it's commercial real estate that could be the biggest problem. And 50% of loans in the USA for commercial real estate are on the books of the regional banks. So all of these things stacking up, I think we're just in the first innings of the bank crisis in the United States.
U.S. Bancorp could very well be the next bank to fail, and that would undoubtedly send another wave of ripple effects through the entire banking industry. On Thursday, the S&P Global Ratings downgraded the bank's long-term credit ratings from A+ to A. According to the credit rate firm, the bank's outperformance has narrowed compared to its rivals. In its report, S&P Global said, although U.S. Bancorp continues to generate higher earnings than its large regional bank peers, we believe its overall performance advantage has narrowed as those peers have gained market share and delivered stable results. The credit rate firm added that the bank might need to build capital ratios to meet regulatory requirements by the end of next year should its assets grow. Do you think U.S. Bancorp will be the next domino to fall in the banking sector crisis? Please drop your replies as well as your comments on Greg Foss' interview in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.